Hey guys, welcome back to the channel. So today, we are talking about something that most people are doing completely wrong, and it's costing them thousands of dollars every single year without them even realizing it. I'm talking about credit cards. Yes, credit cards. Now before you scroll away thinking, oh great, another video telling me to get a cashback card. Stick with me, because this is not that video. Most people use maybe 2% of what a credit card can actually do for them. They swipe, they pay the bill, and that's it. Game over. But if you actually understand how these reward systems are built, how banks design them, how points get valued, how the smart money moves, you can turn your everyday spending into what's basically a second income stream. We are talking about turning $100,000 of spending into $2,500 too. $8,000 of pure extra value every single year. In this video, I'm going to break down the entire system, the ecosystems, the multipliers, the tax angle, the transfer partner tricks, and also the risks nobody talks about. This is a long one, so grab a coffee, get comfortable, and let's get into it. Okay, so let's zoom out first and understand the big idea, because this is the foundation for literally everything else in this video. For everyday people, credit card rewards feel like a nice little bonus, maybe a free flight once a year, maybe a bit of cash back around the holidays. Cute, but not life-changing, right? But for high-volume spenders, think business owners, freelancers with big expenses, people running ad campaigns, anyone pushing serious money through their cards, rewards stop being a perk and start behaving like a yield, like an investment return on your spending money you were going to spend anyway. Now look at these three numbers on screen, because I want these to stick in your head for the rest of the video. Number 1, 2.5 to 8%. That's the effective net return you can realistically engineer on your card spend if you route it correctly. Number 2, 0% tax. That's right, under current treatment, this money generally isn't counted as taxable income. We'll get into exactly why in a bit. And number 3, 1.5 to 2.2 times. That's the multiplier you can unlock just by moving your points through the right transfer partner, instead of just cashing them out lazily. So basically, this entire video is a roadmap of 5 things: how the ecosystems work, the advanced bank strategies, how businesses can route expenses smartly, the tax side of it, and finally, how to actually convert points into their maximum real value. Let's start with the ecosystems. Alright, now here's where a lot of people's eyes glaze over, because we're about to talk about a formula. But trust me, stay with me, because once this clicks, you will never look at a credit card the same way again. Most people think of cashback as just a fixed number. Oh, this card gives 2%. Done. But that's a lazy way to think about it, because the real return you get is actually a combination of 4 separate things working together. Look at the screen. Effective yield equals your base category rate, so how much the card pays you on that specific type of purchase, multiplied by your ecosystem redemption multiplier, meaning how much extra value you unlock when you redeem those points smartly instead of just taking flat cash. Then you ADD your sign-up bonus amortization, basically spreading that big, juicy welcome bonus out over the year you earned it, because that's real value too. And finally, you subtract your annual fee drag, because if a card charges you $95 a year, that has to come out of your return somewhere. Here's why this matters. 2 cards can both say 2% cashback on the box, but one of them might actually be giving you a real return of 1.2% once fees are factored in, while the other, through smart redemption, is quietly giving you 4 or 5%. Same sticker, completely different reality. So the mindset shift here is this: stop thinking of your credit card as a flat rate tool. Start thinking of it as a machine with dials you can turn, category rate, multiplier, bonus timing, and fees. Every one of those dials is something you control. That's what engineering your yield actually means. Now let's get specific, because ecosystems is a word I've been throwing around, and I want to actually show you what that means with real numbers. Here's the thing nobody tells you. Not all points are created equal. A point from Chase and a point from Capital One are not the same thing, even if your statement shows the same number. It's like comparing air miles to gym membership points, different currencies, different real-world value. Look at this table. Chase Ultimate Rewards. Their points are worth about 1 cent each if you just cash them out flat. Boring, right? But if you transfer them smartly to travel partners, that same point can be worth 1.8 to 2.1 cents. That's basically double the value for doing nothing except choosing a smarter redemption path. American Express. Membership rewards is even more dramatic. Their flat cash value is actually lower, sitting around 0.6 to 1.1 cents. But push it through the right transfer partner and you're looking at 1.7 to 2.2 cents. So Amex almost punishes you for taking the lazy option and rewards you heavily for doing your homework. Capital One and Bank of America follow a similar pattern, just with slightly different ranges. Now look at the bottom section, the category multipliers. This is where the real everyday value lives. Chase gives you 5x on office supplies. Amex gives you 4x on groceries and dining, 5x on airfare. Capital One gives you 5x on hotels and rental cars. Buffet can push you up to 5.25% on customized categories. The big lesson here: don't pick a card. Pick an ecosystem that matches where your money actually goes every month, and then stack the right card inside that ecosystem for each category. That's the difference between a hobbyist and someone who's actually optimizing. Okay, this next one is honestly one of my favorite strategies in this entire report, because barely anyone talks about it, and it can quietly add hundreds, sometimes thousands, of dollars a year, with almost zero extra effort. It's called the Bank of America Preferred Rewards Platinum Honors Boost. Here's how it works. If you keep or invest $100,000 or more combined across your Bank of America and Merrill Edge accounts, and remember, this could just be sitting in something boring and safe like a low-cost index fund or US Treasury bills, Buffet rewards you with a 75% boost on all your card earnings. Not a one-time bonus. A permanent, ongoing boost as long as you maintain that balance. Let's make this real with numbers. Look at the left card. Their unlimited cash rewards card normally pays 1.5% flat cash back on everything. No categories to track, dead simple. With the Platinum Honors Boost, that jumps to 2.625%. On the right, their customized cash rewards card goes from 3% up to a massive 5.25%. In your chosen category, up to quarterly spending caps, of course. Now here's the mental shift I want you to make. That $100,000 isn't spent, it's parked. It's collateral. It's just sitting there, quietly working in the background, growing on its own, while also permanently boosting the return on money you were going to spend anyway. Groceries, gas, subscriptions, everything. Obviously, this strategy only makes sense if you already have that kind of capital available and it fits your broader financial plan. This isn't advice to go take out a loan to hit the threshold. That would defeat the entire purpose. But if you're already sitting on that kind of savings in a regular low-interest account, moving it here could be a genuinely smart, low-risk move. Alright, now let's talk business, because if you run any kind of business, freelance, or side hustle, this next section could honestly be the most valuable 5 minutes of this entire video. If you're spending real money on things like digital ads, inventory, cloud software, or logistics, using just ONE generic business card for everything is like using a butter knife for every single job in the kitchen. It works, technically, but it's nowhere near optimal. Let's go category by category using this table. Digital advertising, so your Meta ads, your Google ads, these are usually huge, recurring expenses for a lot of businesses. The Amex Business Gold or Chasing Preferred cards give you 4x or 3x points specifically on this category, up to a $150,000 capital on $250,000 of ad spend. That alone is worth around $9,000 to $12,000 in point value. That's not pocket change. That could be a full month of ad budget you basically got for free. Office supplies and telecom, smaller category. But the Chasing Business Cash Card gives you 5 times back here, up to $25,000, worth around $2,500. Then for large, UN categorized purchases over $5,000, think big equipment or bulk inventory orders. Amex Business Platinum quietly gives you 1.5x on those, which adds up to around $6,750 on a $250,000 spend. And for everything else, your general day-to-day operating expenses, something like Capital One, Spark or that Buffet Platinum Honors card we just discussed becomes your catch-all, landing you over $6,500 in pure cash value. The big idea here, stop asking which card should I use for my business. Start asking which card should I use for this category? Because the moment you split your spending intelligently across 3 or 4 cards instead of jamming it all onto one, you're basically giving yourself a raise just by changing which piece of plastic you tap. Now, I know what a lot of you are thinking right now. Okay, but surely I have to pay tax on all this extra money, right? And this is honestly one of the most misunderstood parts of the whole rewards game, so let's clear it up properly. Under current IRS guidance, specifically IRS Publication 525 and Revenue Ruling 76 to 96, credit, card cashback, points, and miles that you earn through your own spending are not treated as income. They're classified as something completely different, a rebate, basically a post-purchase discount. Think of it exactly like a store coupon. If a store gives you 10% off, the government doesn't tax that discount as if it were income. Because you're not gaining new money, you're just paying less for something. Rewards points work under that exact same logic. So look at this comparison on screen. If you earn $50,000 worth of rewards this year, that entire $50,000 goes straight into your pocket, fully realized, tax-free. Now compare that to trying to earn that same $50,000 as regular taxable business profit at a combined federal and state rate of around 47%. You'd actually need to generate almost $100,000 in pre-tax income just to walk away with that same 50 grand. That is a massive difference in efficiency. Now, quick but important disclaimer. Because I take this seriously, tax law can shift and your personal situation, business structure, or state might change how this applies to you specifically. This is general information, not personalized tax advice, so please, always run your specific numbers past a real CPA before making big decisions. But broadly speaking, this tax-free treatment is exactly why serious spenders take this whole rewards game far more seriously than the average person swiping their card for a free coffee. Okay, this next part is where a lot of people leave massive amounts of money on the table without even knowing it, and it comes down to one simple habit: cashing out points instead of transferring them. Here's the deal. When you redeem points for straight cash, you're basically always getting a fixed 1 cent per point. Flat, boring, predictable. That's your floor value. Think of it as the emergency exit. Always available, but never the best option. But here's the move the smart spenders make. Instead of cashing out, they transfer their Chase or Amex points to airline and hotel partners, names like Virgin Atlantic, Air France KLM Flying Blue, or the Avios program, and book premium cabin flights or luxury hotel stays with them. And look at this formula on screen. It's actually simple once you break it down. You take the real cash price of that ticket, subtract the taxes and fees you'd still have to pay, divide that by the number of points required, and multiply by 100. That gives you your realized cents per point, or CPP for short. Now here's the punchline. While cash redemption caps you at that flat 1 CPP, strategic award Bookings routinely land you between 2.5 and 5 cents per point, sometimes even more for premium, international business or first-class seats. That's not a small improvement, that's potentially 5 times the value for the exact same points, just by being intentional about where you spend them. Do the math on that. And a card that earns you 4x points effectively starts behaving like it's giving you a 10 to 20% return on your original spending. That's an insane number when you actually sit and think about it, and it's sitting right there, available to anyone willing to spend 20 extra minutes researching a transfer partner before hitting redeem. Now, before you go max out every strategy we've talked about, I need to pump the brakes for a second and talk about risk, because this is the part most get-rich-quick credit card content conveniently skips. Rule number 1, avoid manufactured spend. This means things like buying bulk Visa gift cards or money orders just to artificially rack up points without any real purchase behind it. I get why it's tempting, but banks are not stupid. They run serious AI-powered fraud detection specifically built to catch this exact pattern. Get caught, and they won't just close your account, they will straight up confiscate every point you've earned. All that hard-earned value, gone, instantly. Rule number 2, and honestly the most important rule in this entire video, automate your full payment every single month, on time, no exceptions. Here's the brutal math. Credit card interest rates typically sit between 20 to 29%. April. That number instantly wipes out ANY reward spread we've talked about today. It doesn't matter how brilliant your point strategy is if you're paying interest. You are guaranteed to lose money overall. This single habit is what separates people who profit from this system and people who get hurt by it. And rule number 3, audit your annual fees regularly. A card with a $500 annual fee sounds scary, but if it's giving you lounge access, travel credits, and other perks worth $700 plus, it's still a great deal. But if you're not actually using those benefits, that same card becomes dead weight, quietly draining your yield. Once a year, sit down and honestly ask, is this card still earning its keep? If not, downgrade it or cancel it. Basically, this entire strategy only works if you treat it with discipline. It's not a loophole, it's a system, and systems need maintenance. Alright, let's bring this all together, because we've covered a lot today, and I want to leave you with 5 clear, actionable points before we wrap up. Number 1, your effective yield is engineered, not accidental. Category rates, transfer multipliers, bonus timing, fees. Every piece is a dial you control. Number 2, relationship tiers. Like that Buffet Platinum Honors boost we talked about, can permanently increase your baseline earning rate. This isn't a one-time bonus, it's a structural upgrade to how much you earn, forever, as long as you maintain it. Number 3, award travel redemptions. Done right, will almost always crush flat cashback. Redemptions. Don't take the lazy exit unless you truly need the cash immediately. Number 4, under current guidance. These rewards are treated as non-taxable rebates, not income. Huge efficiency advantage, but always double check with a CPA for your specific situation, because rules can and do change. And number 5, maybe the most important one, none of this works without discipline. Pay your statements in full, avoid manufactured spend, and regularly audit your fees. The strategy is powerful, but it's not magic, and it punishes carelessness just as much as it rewards smart moves. If you take just anything away from this video, let it be this: stop treating your credit card like a piece of plastic you swipe out of habit. Start treating it like a financial tool with real, measurable leverage, because that's exactly what it is, once you know how to use it properly. Quick but important note before you go. Everything covered in this video is for educational and informational purposes only. This is not formal tax, legal, or financial advice. Bank policies, reward structures, and point valuations change over time. So always confirm current details directly with the issuer and speak with a qualified CPA or financial advisor before making decisions specific to your own situation. Alright, that's the full breakdown. If this video helped you see credit cards in a completely different light, do me a huge favor, smash that like button. It genuinely helps this channel grow. And subscribe if you want more deep dive, institutional style breakdowns of personal finance strategy. Made simple. Drop a comment down below. Which ecosystem are you already using? Chase, Amex, Capital One, or Buffet? And which strategy from today are you trying first? Thanks so much for watching all the way through. I'll see you in the next one.